Markets were strong in March as global equities rose 2.4%. Japan again to the fore, rising 6.8%. Despite uncertainties in Europe relating to the Cypriot bailout, European equities rose 0.8%, while the US gained 3.8%, with the Dow Jones and S&P 500 reaching new all-time highs. Overall, equities continue to be supported by better economic data, expectations of continued easy global monetary policies, an agreement to fund the annual US budget out to September, and ongoing flows into equity funds. Eurozone bonds were up 1% as German yields fell, with investors moving to safe haven assets following events in Cyprus. The decision to place a levy on all bank deposits in Cyprus as part of the initial bailout proposals led to fears that deposits across Europe would be at risk in any future bailouts or extensions to existing agreements. This was quickly revised, with deposits under €100,000 being protected in full, as per existing guarantees, with only those above €100,000 being subject to a levy. In hindsight, decision makers realised the shortfalls and potential contagion from the original policy decision, and have since emphasised that the outcome for Cyprus is not the template for future support programmes. The features of the Cypriot banking system, whereby it accounted for over 800% of GDP, had limited funding from bond issuance, therefore offering minimal recovery through discounting bondholders, and had a relatively large overseas deposit base, much of which was suspected of being associated with money laundering, do suggest that the terms of the bailout are likely to be one-off in nature, as affirmed by the ECB. The Bank of Japan surpassed expectations and other global quantitative easing programs as it announced bold new monetary policy initiatives to stimulate the economy. Its balance sheet will exceed those of other central banks as it plans to double the monetary base by the end of 2014 by doubling its holding of government bonds with purchases of 5.5 trillion yen per month, and increase holdings of equity and real estate assets by 1.3 trillion yen as it intends to achieve its 2% inflation target in 2 years. The unprecedented level of easing has increased the belief that Japan can finally revive its economy after 2 decades of lost growth. The resultant fall in Japanese bond yields has also contributed to the lowering of yields in peripheral Eurozone bonds, as Japanese investors seek alternative, higher-yielding assets in other currencies rather than the yen, which has continued to weaken under policy measures. Global and US growth in the first quarter are likely to have exceeded 3%. Early releases in April, however, indicate growth may ease through the second quarter as the pace of improvement in employment and manufacturing appear to have slowed, as has occurred in each of the last 3 years, although the recovery remains on track and should improve again later in the year. In Europe, business sentiment surveys deteriorated in March, suggesting recovery will be delayed, increasing the likelihood of a policy response from the ECB through rates or other unconventional measures. The Japanese outlook has improved post-policy announcements, while China remains set to generate growth of over 8%. Global equities are up 9% year to date and continue to provide upside, supported by attractive valuations, ongoing monetary support, rising earnings, corporate share buybacks, low returns from other assets, and a supportive economic backdrop, notwithstanding recent figures. We expect equities to climb higher over the remainder of the year, but the pace of gains evident in the first quarter will be difficult to maintain in the short term, particularly given some potentially slower economic data in coming weeks. Returns from Eurozone bonds are expected to be modest overall, given the current low absolute yields in Germany, but peripheral yields still have scope to move lower.